Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 283 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. So good morning, Matt.
Good morning, Mark.
Very chilly morning here in Dayton, Ohio. I think it's mid to low single digits, which isn't
without
very fun.
The wind chill.
Without the wind chill, which is not very fun. So
yeah, getting the kids out of the house after the break in this cold weather is quite the challenge.
Did they have school today, Oakwood?
They did have school today. And, what's interesting with it is, as you can imagine, most parents are dropping off their kids instead of allowing them to walk.
Yeah, because it's our community that we live in is a walking community.
Yeah, there's no bus system. Yeah. And so what my kids don't understand is that when I'm like, we have to leave so much earlier in order to get you there on time. And then when we're in the car line, and they start yelling at me, Dad, we're going to be late. Dad, we're going to be late. It's like, I told you so.
Right.
Yeah, that was my morning.
Fun times.
Yes.
Fun times. Can't wait for that.
I guess the analogy with the markets is volatility is going to come this year. We told you it was going to happen.
Right. We previewed this,
yes.
So shouldn't be surprised.
That's right.
As always, we will quickly review the month-to-date and year-to-date performance, which obviously is the same for January. Of the major market indices that we track, this data is from Y-Charts and as of the market close on January 8th.
Okay.
S&P 500 index up 0.6% to start this year. Dow Jones Industrial Average up 0.2%. The NASDAQ Composite up 0.9%, the Russell 2000 Small Cap Index up 0.3%, and the Vanguard All World ex United States ETF is up 0.5% to start the year. 3-month Treasury rate at 4.35%, the 2-year Treasury rate at 4.28%, and the 10-year Treasury rate at 4.67%. It's moving on to big headlines and current events from the week, Matt. I think it's just important to note that earnings season kicks back up into full gear here next week, starting with the major banks reporting. I think Wednesday, Thursday, Friday, or Thursday, Friday, something like that. So your JP Morgans of the world, Bank of America's, Citigroup, PNC, Goldman Sachs, down the line you go. So yeah, kind of hard to believe. I feel like we say that every time we enter earnings season, but here we are again, ready for companies to report how they did in Q4 2024, and then, if their fiscal calendar is a calendar year, how they did for the full year of 2024.
Yeah, I think it's a good preview. One thing I have on deck for our listeners and viewers today is my main piece has to do with commercial real estate loans and what's happening right now with longer term interest rates and why you might see some headlines regarding the banks as the year goes on. I have a piece on that.
Okay. Well, moving right along into tweets, articles, and research from this week. The first thing that I had was a blog from Adam Turnquist with LPL on January 2nd titled Santa Claus Rally in Jeopardy.
Dun, dun, dun.
Yeah, so...
Jen, I'll do the side effects.
So for those who don't know or might be new to the podcast, the Santa Claus Rally indicator tracks the performance of the S&P 500 the last 5 trading days of the year and the first 2 trading days of the new year. And usually this is a relatively decent indicator of how the stock market will perform in the new year.
Okay.
So kind of getting into some of the things that Adam said, he says, another important aspect of the Santa Claus rally period is its linkage to January in the following year's returns. As Yale Hirsch put it, if Santa Claus should fail to call, bears may come to Broad and Wall. Historical data supports this adage. When investors are on the quote-unquote nice list and Santa delivers a positive rally, the S&P 500 has generated an average January return of almost 1.5% and an average following year return of 10.4%. This compares to the respective average January and following returns of a negative 0.2% in January and a positive 6.1% for the full year when investors are on the quote-unquote naughty list and a negative Santa Claus rally return.
No one wants to be on the naughty list.
No one wants to be on the naughty list. So you'll see this graphic that Adam has here on the YouTube video. It'll also be in our show notes that shows the average January return and the average next year return if we're on the nice list or the naughty list for the year. But I do think it's important that we shouldn't take this as biblical, because the Santa Claus rally period was negative for the S&P 500 last year. And we all know that 2024 was another very strong year for stocks. So just want to throw that caveat out there. And in my opinion, what we really want to watch this month is the performance of the S&P 500 during the full month of January. So I think this indicator does a better job than the Santa Claus rally of projecting if stocks are going to have a good or a bad year.
Yeah.
So we'll follow up with listeners at the end of this month on that topic.
Not to get too deep in the weeds, because I know we have a variation of listeners in their, I would say, their skill level or knowledge of the market. The one thing that's concerning to me, since I've noticed, I think it's the second week of December, some of the performance data of the equal weight S&P 500 versus the market cap weighted. And when you start really diving into it, the relative performance of the equal weight S&P has not been good at all since the second week of December. And I think you could probably blame the Fed, right, for that. But it's just interesting. I'd be curious to see as January goes on, not only the market cap weighted index, but how the equal weight's doing, if that makes sense.
Yeah, and I think, for newer listeners, when the equal weighted S&P 500 index is getting outperformed by the market cap weighted S&P 500 index, usually a sign of weak breath, right? So so usually showing that, the top 10, 20 largest names in the S&P 500 are kind of keeping the market afloat. And if you look under the hood, there are a lot of names starting to deteriorate.
Great explanation. I like
obviously, we want to see that, over a longer period than just a couple of weeks like we have right now. But definitely something to be aware of for sure.
Well said. And another thing I'll add to it that you usually say is sector rotations within the index tends to be healthy. And I know that's something that you will monitor as the year goes on.
Yeah, for sure. Second thing I had was from our friend Ryan Dietrich. This was back on December 31st, a tweet that he made. He says, one of the worst quarters during the 4-year presidential cycle starts tomorrow. And Jenna will throw this up on the YouTube page. It'll also be in our show notes, this tweet from Ryan. We hinted at this when we were doing our questions segment with Matt and Mark earlier this week, Matt. But Q1 of a post-election year tends to be pretty weak, relatively speaking, right?
Correct. I remember you mentioned this.
So, it wouldn't surprise me. The only reason why I want to point this out is it wouldn't surprise me if we kind of just chop sideways. Markets didn't really do a whole lot in the first quarter, and I just don't want that to be alarming for anyone based off of the prior 2 years we just came off of, right? Because everyone's used to, rocking and roaring stocks.
Why isn't my account up 1+% for the month?
Right, exactly. So again, just want to be aware of it. That does not mean that it can't be a strong Q1, but historically speaking, returns in Q1 of post-election years have been muted.
I think it's great to point out.
So,
real quick on Ryan.
Yeah.
He had a post just yesterday.
Yeah, I saw
Did you
that.
see it?
Sad. Yeah, his brother.
So his brother
cancer.
has stage 4 cancer, and he was in the hospital with him. So I just want to throw that out there. Keep Ryan's brother in your thoughts and prayers.
Yeah, he's definitely in ours. Ryan, great guy. So I can only imagine that his family, awesome people too.
Yeah.
So last thing I had was a series of tweets from Lawrence McDonald back on September 18th and September 21st, Matt. So I was kind of digging back into the backlog here. But he says, in the first tweet on the 18th, there is only one reason why the Fed cut 50 basis points this week. So if people remember, September was the first time that the Fed cut during this cycle.
And there was critical that they should have done it at the meeting before that and didn't. So they
Right.
were making up was the perception.
And he says they must get front end rates lower as this colossal wall of debt matures. And then on the 21st, he said interest payments on the federal debt load. And I'm not going to read the whole thing, but essentially in 2024, the interest payments alone on the federal debt totaled about $910 billion.
That's just interest.
That's just interest. And in 2025, it's projected to be over $1.1 trillion, which is crazy.
You know, this goes back to, what I said at the podcast a week ago, things to monitor as the year goes on. And I'm telling you, if you start to see the long end of that curve go above 5, that's not good in my opinion. And, ultimately there needs to be an appetite to bring these rates down. You got to have some buyers who are willing to buy this paper. And they're going to have to offer higher rates, I think, to entice people. That's a concern of mine.
Right. So that's the kind of conundrum that we're in right now. And in 2024, he set a record of $8.9 trillion of government debt matured, more than 1/3 of the total debt outstanding.
And they had to roll that. So I want you to think of a company that has to take out debt to fund its growth. That has to, you don't pay all that off, say, in 5 years. So when that comes due in 5 years, you got to roll that, and then you are then subjected to whatever the interest rates are in the given environment for your credit rating. Is that a good way of saying it?
It's not like that gets like retired, right? It's like, it's like, think about it. I think a simplistic way to think about it is, you buy a 30,000 square foot mansion, and was built in the 1990s, and you want to renovate it, right? And you take out a loan for the first year and you do a bunch of updates to it in the basement, for example. Then you take out another loan the second year to do the mid floor. Then you take out another loan to do the top floor. And with the federal government, they need to continue to fund their operations the way at least the government is run right now. And they're just in a constant need of more money.
They're spending more money than they're taking in.
Right. And if you think about it, we talked about this back in 2019 and 2020. It really wasn't an issue back then because interest rates were close to zero. But now you have interest rates, that are the 10 years pushing 5%. It's just got a lot more expensive in a relatively short period of time for the government to continue
borrow
to
that money.
operate.
Borrow that money.
So
yeah,
this is going to be something that is going to be quite interesting because again, we've had the conversation of at what point does the federal debt load matter, and I think we're always of the opinion, well, it really has to do with interest rates because is really the wrecking ball that could come and wreak havoc.
That's right. And, you got to look at that debt to GDP. I mean, you can kind of grow your way out of it, but ultimately I think they're going to have to grow their way out of it and cut expenses one way or another.
Right.
All right. My first piece is just delivering a little bit of dose of reality. I hate to be the wet blanket, so I'm going to start with my negative first, is expect beef prices to go higher at the grocery store. So this chart caught my eye. It was a post by Bar Chart, Mark, just recently over this past week. And what they did is they showed the price on the Chicago Mercantile Exchange of live cattle on the February 2025 contract. And if you look at it, Jenna will put up this chart for our YouTube viewers. This will be in our show notes. You're going to see that we are pushing literally all-time highs in the price of beef.
Yeah.
So if you're at the grocery store, don't expect any relief in the immediate future in the price of beef. And I'm sure there's a lot of circumstances underneath as to why that is. I'm not here to go into that other than just to point this out.
Yeah. Good point.
Next, my big piece for this week for our listeners and viewers, Mark, is about banks. Okay. I'm going to do a little bit of education on this topic. It's in regards to commercial real estate and commercial real estate loans and how it relates to the banks. So here we go. With interest rates trailing higher on the farther end of the curve, that's 10 years plus in maturity, over the past several months, This is a topic that does not help banks that have large amounts of commercial real estate loans on their books. CRE loans are designed to be amortized over 20 plus years with balloon payments in maturity, typically in 10 years. So here's the thing. Can individuals afford, first point, to refinance the loan at today's rates? So let's go back, say 5 to 10 years ago when that loan was originally taken out. Probably was taken out at a lot lower interest rate. So when that 10-year loan comes due, they might have been paying 3. Going rate now for that real estate is fill in the blank mark, 6.8, 7%. And can they afford that difference? Here's the second factor. Do they have enough equity in the property to not have to bring money to the table to conduct the refinance? In essence, has the property appreciated in value? So I'm going to use an example locally. This is not going to be 100% to the numbers, but it's going to provide an example. So in the Dayton, Ohio area, there's a popular kind of outside mall called the Green. And when the Green was originally built, the total loan to get it all done was really large, Mark. It was $120 million. Okay? So if you fast forward to when this loan was maturing and needed to be refinanced, the refinance amount was 10 to 15 million above what the market value was for the property, because the desire for those types of investments have come down. Okay. So the individual who was the debt holder had to make a decision. Do I come to the table with 10 to 15 million to refinance this debt at a higher interest rate? Or do I play ball with the bank and I might lose the property? They might have to take it over, assume that 10 to 15 million dollar loss, and sell it to someone else. Mm-hmm. So I want you to use that as an example as I go through this.
Yeah.
Is that a good way of saying it, Mark?
Yeah.
So there was a post by Unicus Research, UNICUS Research, and this was done recently over the past week. And this post says, we have begun to see default cracks in commercial banks, and they mention some smaller ones in this post. According to our sources, a sizable default is expected to be underway in one of the banks. And they had this post where it showed more very small regional banks that have a high amount of their reserves tied up in these commercial real estate type loans. And I won't go through them verbatim, but I want to bring this up that if we start to see longer end rates go up, you're going to see more pressure from these banks. And it was just a couple years ago in 23, we had some spurts of a couple bank failures, right? We could potentially see some additional headlines at some point this year regarding this topic, okay? So one of their other points is, according to the FDIC's third quarter 2024 banking profile, the number of banks on the list of problem banks increased by 2 in the third quarter to a total of 68, and they held total assets of $3.9 billion. I'm sorry, it increased by $3.9 billion to $87.3 in total. So here's my bottom line to this conversation. Could this be nothing, Mark? Yes. Could we see some bank failures this year in 2025? Possibly. Could those bank failures cause some sort of domino effect or systemic risk that's spread to other banks? Possibly. In my opinion, I do think the damage will be contained, but it is something that is really not being talked about since 2023. If longer dated rates remain elevated, that is not going to help this problem. One last thing, this caught my eye by digging into it a little bit further. There was a post by a trader that I follow, Tracy. Can you help me pronounce her last name, Mark? Is it the
page shoe chart?
Shoe chart, top of page 5. She got great stuff. She posted this on December 15th. I catalog a lot of stuff like you. Quote, About $500 billion of commercial real estate mortgages will mature in the next year. And, quote, a significant portion of them are going to go into default, according to Florida Atlantic University Cole. He said they're going to be fire sales. There's going to be more downward pressure on commercial real estate prices across the board. And then Tracy posted a chart by Bloomberg that was kind of illustrating the delinquency of these types of loans by different types of commercial real estate. It's categorized by things like office, hospitality, retail, multifamily, industrial, and mixed use. So I think this needs to be added to my list of 2025 items to watch as the year goes on that I started last week. What's kind of your initial thoughts and comments regarding this topic, Mark?
Well, this last chart's pretty interesting to me because, it looks like from this chart from Bloomberg, the loan delinquencies that are, rising the highest are office real estate, right? Mm-hmm. Which just so happens to coincide with, I think it was earlier this week or last week, JP Morgan was like, hey, everyone's coming back to work into the office 5 days a week. So I just wonder if this, work from home phenomenon, has, crushed these valuations of these office properties, right?
Well said. Keep going.
And then now people are starting to realize that.
It's affecting business. It's affecting creativity, productivity.
Right, and I wonder if that's maybe a small reason why a lot of these major publicly traded companies who a couple of years ago embraced the work from home culture are now like, you have to come in 5 days a week or you no longer have a job here.
Yeah, and I think a lot of employers had to because the labor market was so tight, and you kind of have not a full 180 of that, but it's been completely different. And all it's going to take is a couple of key employers like a JP, and I say key, larger employers to do that, and a lot of people are going to follow.
Yeah.
You could be spot on with this, Mark.
Just a thought. I just put those two dots together when I saw that chart.
So I would just throw it out there. If you're an investor in banks, let alone smaller or regional banks, this is something I would just take note of. I don't think it spells doom and gloom. I think what you could see is a lot of banks who go to borrowers and make special deals. So, okay, I'll allow you to extend this 3 more years, and then we'll cross that bridge when we come to it. Meaning, keep making that same payment for the next 3 years. Let's see what the value of the property is, and then I might take it from you then.
Right.
So, not immediately doom and gloom, but I think there is a lot of unrealized losses on these bank balance sheets right now, and it's going to be interesting how they take care of them.
Yeah, not that this matters at all, but I think it was in the first quarter of 2023 when we had like the Silicon Valley Bank failures and the other
Correct, sir.
ones too.
We haven't heard much since then, right?
No.
This is why people listen to the Independent Advisors podcast, right? We're giving them the stories and the information that the market's really not talking about. That's not a mainstream narrative that I think has a potential to come to light as the year goes on. Mm-hmm. All right, my next piece, Mark, is in regards to my periodic reminder of following others. And this was a post by Peter Malloch. And let me get the date because I don't want to mess this up. It was January 3rd, Mark. Mm-hmm. And what he did is he posted S&P 500 total returns following Michael Burry's stock market warnings. Michael's an individual that nailed some key trades back in the great financial crisis on subprime mortgages. And it was really interesting. His chart gave me a bit of a chuckle. And so what the chart indicates is that Michael was indicating all caps that you need to sell. I have to give a little emphasis there on January 31st of 2023. And the following returns, S&P up 49%. September 29th of 2022 could be worse than 2008. S&P since then up 67% through the end of 2024. June 16th of 2021, greatest speculative bubble. S&P up 47% through the end of 2024. Two more, March 13th of 2020, significant bearish market bet he was putting on. S&P up 134%. August 28th of 2019, quote, bubble in passive investing, S&P up 122% since then. My point is, some of these investors, I would consider this an institutional investor. They have different time horizons, different risk tolerances, different trading methods. They don't have to come back to you in a week and say, our thesis has changed, we're doing X, Y, Z. I just want to kind of throw caution out there that these are not headlines that I would take as actionable for someone's long-term financial plan. That's my word of caution. Just like a clock that's broke, 2 times a day, this guy's going to absolutely nail it, and people are going to look back and say, why weren't we listening to him? That's going to happen. Mm-hmm. But you can't take every one of these clickbait headlines and then take action on that. Your 2 cents.
Well, it's funny that you brought this up because last night I saw that this Robert Kiyosaki guy posted on X
Rich Dad Poor Dad?
The Rich Dad Poor Dad guy.
He's had some horrible calls over the past decade.
Well, yeah. So I was going to save this for another podcast, but I think it's important since we're talking about it now. So this was just yesterday. So he posted on X, I warned y'all, 2013 published Rich Dad's Prophecy. Prophecy predicted the biggest stock market crash in history was coming. That crash is now, in all caps.
So it took 12 years?
Yeah, that's what it's insane. How did I know this giant crash was coming? I knew because in 2008, our leaders, led by Fed Chairman Ben Bernanke, paid himself and bankers billions in bonuses while millions of mom and pop lost homes, jobs, savings. In 2025, the car market, housing market, restaurants, retailers, and even wine sales are crashing, making everything worse. World is on the verge of war. Please be smart. Keep your eyes and ears open. Many expensive assets such as houses, gold, silver, and Bitcoin will go on sale. I will be buying more real assets with fake US dollars. Time to be cool and be smart while millions are panicking. FYI, I practice what I teach and preach. I will be at the Vancouver Resource Investor Conference listening to smart investors and looking at gold and silver mines to invest in. Crashes are a great time to get rich, get smart, and get ahead in life. Take care. And it's just like,
anytime I hear the terms "get rich quick,"
yeah, it's just like stuff like this. It makes my blood boil because it's like this guy. I feel like it's every month he says that type of stuff. So
yeah, I mean, he's definitely the situation. This is going to be a very crude analogy, but I think it applies. Is the boy who cried wolf? At some point, he's going to be right. Mm-hmm. Right?
Yeah.
And I just think it's interesting how media in general will assimilate these clickbait headlines, and I'm just concerned that people will follow those as biblical and could give them harm. Again, at some point, this guy's going to be right, but how much market participation opportunity did you miss out since 2013?
Right.
And just a concern. Just want to throw it out there that, consult your professionals in your life, like your financial advisor, your money management firm that you utilize. And, ultimately, you got to figure out who has your vested interest at heart.
Yeah, for sure. Well, moving on to the last segment of the cast, financial planning topic of the week this week is from an article at Think Advisor by David Blanchett, titled How Retirement Age and Social Security Claiming Age Are Related. And there's also commentary from Kitsis.com on this. So this was back on December 16th.
Okay.
So they start out by saying Social Security benefits make up an important part of the incomes of many older retired Americans. Nevertheless, individuals aren't required to claim Social Security benefits the year they leave the workforce. And for those with the means to do so, delaying Social Security benefits can be particularly lucrative, with Social Security benefits growing approximately 8% per year after your full retirement age until you're 70 years old when the benefit maxes out, right? Mm-hmm. So according to data from the Employee Benefit Research Institute and Greenwald's Research 2024 Retirement Confidence Survey, 91% of retirees receive Social Security as a source of income, and 62% say that it is a major source of their income. About 75% of respondents who did so between the ages of 62 and 70 claimed their benefits at their retirement age, meaning they did that the year they left the workforce.
That doesn't surprise me so far.
With the four most common Social Security claiming ages being 62, when individuals are first eligible to claim benefits, age 65, which is the median expected retirement age according to the survey, age 66, which is the full Social Security retirement age for most current recipients, and age 70, which is the maximum benefit age. An individual's level of assets appear to play a significant role in their decision to delay Social Security benefits, which can result in a larger monthly benefit. For instance, while only 8% of respondents with less than $100,000 in total financial assets claimed after their retirement age, 36% of those with more than $500,000 in assets did so, likely because this group could use their assets to support their lifestyle so that they can afford to delay Social Security and claiming it at the maximum benefit amount at age 70.
Yep.
In sum, this research shows that while many Americans rely on Social Security benefits to replace a portion of their income after they retire, those who can delay taking benefits can benefit both from a larger monthly benefit and perhaps the opportunity to use the low-income years between retirement and claiming Social Security for Roth conversions and or capital gains harvesting. So
Boom.
I know this is, for the advisors in our office, one of the most common questions that they get is, hey, here's my situation. Here's what my estimated Social Security benefits are going to be.
Here's the amount of income I need to live off of.
When
Here's my assets.
When should I claim Social Security benefits?
When should I do that? How should Roth conversions play into this before my RMD age? How do I handle my unrealized capital gains?
Yeah,
All
and
normal.
the simple answer, right, is wait until age 70 because that's the most bang for your buck. And there's so much more that goes into it than that. Including, making sure your health insurance premiums are lower because that's based on the amount of income that you have. And when you're talking about tax,
so many cross currents.
Yeah, you're talking about tax planning and, let's say you retire when you're 65 and, you go through, let's say 65, let's say 67, and we go through a 3-year bear market. Well, all of a sudden, waiting until age 70 to take that Social Security benefit sounds pretty dang good because that's, a quote unquote guaranteed rate of return of almost 8% per year going forward.
Correct.
But what if you retire in a year where the market bottoms out and the forward returns for stocks for the next 5 years are 15%? Then it's like, oh, well, maybe I should have taken the Social Security out and invested it, even though I didn't need it to spend. So there's a lot that goes into making this decision. So this is an area where I think it's very, very helpful to talk to a professional about. Even if it's not us, that's fine, but talk to somebody that has experience with this stuff because there's just so many different factors that you need to consider before making that decision.
Yeah, we have CFPs on staff, certified financial planners that have the intellect and the knowledge to handle these types of inquiries and provide that advice. My other observation I'm seeing more and more of, Mark, are individuals that retire, that start taking Social Security. This is before 70. And then all of a sudden they get enticed to go back to work part-time. They're making a lot more than $22,000, $23,000. And they suspend Social Security again so it can continue to grow. They're making their part-time income, and then they wait till 70. I am seeing that boots on the ground more and more.
Interesting.
Yeah.
Yeah, so just something to think about if you are, trying to figure out when you're going to take Social Security and all that good stuff. So anything else before we leave it there for the week?
No.
Okay. Well, thanks everyone for tuning in and listening to episode 283 of the Independent Advisors Podcast. We will be back with you next week for episode 284 with a special guest.
Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.